My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the rough hour is Carter Malloy. Going to be talking about farmland, which I've had as a conversation point in several other spaces, but what Carter is doing with his firm is really interesting. So we'll touch on that. Carter, introduce yourself to the audience. Who are you? What's your background? How did you get involved in farmland? And what are you doing with AcreTrader?
Yeah, so this is Carter Malloy speaking. I've been working with AcreTrader here for a little over 5 years. My background's grew up in a farming family, then liked math and music, physics throughout school, ended up in the world of equities. So I spent 12 years as a sell-side analyst at first, and then as a founding partner at a large long-short equity hedge fund. So spent most of my career trying to eke out alpha in public markets, working really long hours. And in the background was buying and selling farmland and falling more and more in love with it. So decided to make it a full-time profession in 2018. So background of AcreTrader is really stems from that. I had friends and the other folks I knew that wanted to invest in farmland, and there was no real easier way to do it aside from going out to a random county, little town you've never been to, plopping down $1 million with a broker you probably never met. And now congrats, you're in the business of managing a farm. So we built AcreTrader to make that very easy for folks to get access to farmland.
Since you mentioned alpha in public markets, I want to make the assumption that alpha is probably highest in markets that people don't have easy access to in general, and things which are probably more relatively illiquid. Talk through some of the data that you've seen around farmland as an investment relative to equities in terms of risk-adjusted returns, correlations, anything like that.
So those are some really fun points, right? And that was frankly a big part of my attraction to it is as this $3.5 trillion asset class. So very sizable asset class here in the US. There was just such little information. The information asymmetry to buyers and investors and empowered with the right data is pretty material in our world. And so being able to put up good performance is something that's highly intriguing to investment professionals in this part of the world. In terms of the historical performance, we're looking at low double digits, so like 11%, give or take, over the last several decades. The important thing about that is the consistency with which it has performed. So this is not a sexy asset class. You rarely hear people saying, I doubled my money last year in farmland, or I lost all my money last year in farmland. It's a very different, slow and steady compounder, which is what we are really looking for as a company and as investors here. So the two sort of angles there. One is the actual performance of it, and certainly has put up some attractive Sharpe ratio or risk-adjusted performance over time. But then also investors with the right amount of information. We can talk a little bit about our intense investments internally here in data analytics. So folks armed with the right information within this market can do relatively well.
Yeah, and I'm sure the data analytics part is the most challenging. You're probably aware there's a lot of value add with what you're doing. How does farmland compare to other real estate from a comparative basis? If we're going to do kind of apples to apples, pun intended, type of comparison, some people might naturally want to compare it against REITs, against other types of properties. What makes farmland unique from an investment characteristic perspective?
Ultimately, the performance over longer periods of times is pretty close to most other major asset classes, if not better than most major asset classes, with the primary differentiating factor being the relative lack of volatility. So just the smaller moves up and down on a quarterly and annual basis relative to a lot of those other mainstream asset classes out there. So that's something we're certainly excited about. And again, we can dig into the data side of the world here in a bit, but that performance is interesting to us standalone. What makes it perhaps even more compelling then is that it does not appear to move with other major asset classes. So we can find very little correlation to other major asset classes out there, like near exactly zero with the S&P as an example. So very differentiated, diversified type of portfolio asset, and one that has performed on a relatively consistent basis over time.
Which presumably makes it more of a, for the most part, an interesting play for institutions that are looking for, targeting certain risk-adjusted returns. A correlation of zero to the S&P, even though the performance has been strong for farmland, it hasn't been as strong as the S&P, and we know retail likes to chase the hot dot. So talk about some of the challenges as a firm with trying to make the case for farmland when, to your point, it's not particularly sexy. And FOMO, I think, is probably harder to achieve in farmland than equities.
We certainly try to avoid being in that FOMO game, right? I think that's if anything, a good counterpoint for our asset. And you hit the nail on the head. Institutions have been here for a while, albeit still relatively small players, right? So institutions a decade or so ago had about $4 billion invested in farmland. Today, it's about $40 billion. So certainly some real growth, but looking in the broader context of the size of the asset class, we're like maybe 2% institutionalized as an asset. Like for that to most commercial real estate that's 30, 50, 75% institutional ownership. So we've seen real growth there on the institutional side. Where we help as a business is helping make it accessible to the rest of us. And that being the rest of us that are looking for interesting compounders and diversification in our portfolio. This is not super hot, super exciting, sexy asset class. And you tapped on it for a second there. What a fascinating sort of component of farmland is this is a real asset. Actually, the conversation came out of an argument with my dad about Bitcoin in 2017, me telling him not to invest. Whoops. But ultimately, around just hard assets and assets that actually produce something. And that's an intriguing component of farmland, something that we can all understand somewhat innately. Farmland produces goods, right? It produces food, fuel, and fiber, primarily food that we all need. So there's growing demand for the products that are coming off of farms. At the same time, there's less and less farmland. So this is a finite asset class. In the US, we lose something like 3 acres per minute, according to the US Farmland Trust. So increasing demand and steadily shrinking supply, especially here in the US, sets up a pretty fascinating outlook for farmland over the coming decades.
Talk about performance in the last 3 years across the space with the caveat that, to your point, it's not necessarily priced real time. So it's hard to know sort of what the true volatility is in the absence of, constantly updated data. But from what you've experienced and seen, how to take us through how farmland performed from 2019 into the COVID crash, into the recovery to where we are now.
It goes back to that consistency of farmland that's pretty fascinating. So if we look at 2008, 2009, 2000, 2001, and similar to the last several years, consistent performance, generally speaking, through those time periods, especially relative to the pretty wild variations in some of the other primary assets that most of us are used to. Within the last couple of years, the example of that would be, call it the 2014 to 2020 period, saw relatively subdued appreciation in farmland. The last few years, we've seen some catch up, some mean reversion towards that long-term trend line. And to back out there, I'm speaking specifically to appreciation. There's also a yield component, right? So as an investor in farmland, you can make money from yield coming off of that land, that being a rent share or revenue share or rent from the farmer. And you can also make money through exposure of the appreciation in the underlying land. The rent tends to be fairly consistent over time, albeit somewhat growing along with commodity price and inflation. And that underlying land then is really what I'm speaking to when I say a little more subdued through the late 2010s, a little more catch up in the last few years. And for some perspective, we're talking about like low single digit appreciation versus like maybe low teens appreciation. So still not a crazy amount of variability there.
All right. So aside from the consistency point, is there anything that's particularly unique about the current cycle that makes farmland maybe more undervalued or more fairly valued compared to history? I mean, talk about sort of where we are in terms of the year and just in general farmland valuations.
There's both an absolute and a relative answer to that question. So on an absolute basis, what an interesting component is improvement in commodity prices. So we've seen real run-ups in things like corn and soybeans, which comprise about 60% of total US farmland. So a pretty monstrous amount of land is dedicated just to those two commodity crops. So those price improvements in underlying commodities have created both better outcomes for farmers. And we work with farmers as landowners and as partners to those farmers that run the operations on top of the land. It has also produced some, relatively interesting setup going forward around just inflation within core commodities. And whether we're looking across CPI or PPI, farmland has tended to outperform in periods of higher inflation. We're talking again like multi-year cycles, not monthly as we discussed earlier. Then there are certainly some pretty material idiosyncrasies within farmland as you dig in from a macro to a micro level, looking at a per parcel basis, a per ag region basis, right? I mean, California, one parcel to the next can mean enough water for forever, a really long time, and enough water for the next 5 or 10 years. Obviously, the latter is very unexciting for most reasonable investors. Then there's the relative performance of the last couple of years. And again, I think that's the really fascinating thing is just the consistency that has been shown through farmland's performance relative to what we've seen going on in the broader economy and in broader, more common asset classes.
All right, so I want to hit on that word, the idiosyncratic aspect of farmland, because obviously you're talking about different geographical parts of the country and different unique aspects. How homogeneous is farmland as an asset class versus idiosyncratic, compared to other asset classes? Meaning, is it, along the lines of that line of, rising tide lifts all boats, or, is there a lot of variability across different types of farmland property?
Both. So, certainly, again, improving commodity prices is generally good for farmland, but there's material dispersion in returns, right? You can't just walk out and buy a piece of farmland and go, great, I've got exposure. This is going to work out in the long run. And very well made because of that rising tide can help. But the bigger picture, it is really hard. And that's what we focus on as a platform. We're 80 or 90 folks here, mostly in Arkansas. And we focus the large majority of our efforts on what we would call the supply side of our business, on sourcing first and foremost, which is very difficult to get exposed to large volumes. And we do that through a broker dealer structure that we can discuss later. And then also the diligence side, just having both the data and the analytics to run the analysis, but also the team and the expertise to be able to understand all of the regional and sub-regional and even like literally neighborhood dynamics.
Okay. And I'm going to assume that there's a lot of, elements of kind of boots on the ground to some extent to make sure, and as far as due diligence on that sourcing point, what about sort of concentration of ownership? So I think a lot of people, when they think about farmland, they think, of something that's been in a family for a long time, that's a generational type of ownership, but, maybe one or two properties. Is there concentration by some select players in different farms, or is it a very fragmented type of part of the investment life?
It is incredibly fragmented. I think that's a great question to call out, one of the many perhaps misconceptions, right? Like one of those is Bill Gates is now the largest farmland owner in the United States. Oh my gosh, what's he doing? Is he taking over our food supply? Like I think he owns something like 7 or 8 basis points. And if I'm wrong, 10 basis points of US farmland, call it highly productive crop ground. So, and that's the largest single or individual farmland owner in the US. So according to reports anyway. So it is a highly fragmented industry, and one where you're right, it is a closely held asset, but something like 40% of farmland is already absentee owned, meaning that, grandkids inherited it or somebody purchased it and rents it out to another farmer. So the idea of farmers renting farmland is incredibly common throughout our industry. And then lastly, speaking to liquidity, is a percentage liquidity is certainly lower than it is in other asset classes, but on an absolute basis, we're talking about $50 or $100 billion of farmland that's bought and sold every year anyway. So we like to participate within that market.
Okay, so let's talk a little bit about the firm AcreTrader and what you built, because it seems like you're straddling the line between data analytics, broker dealer, and advisor. From what I'm seeing, all at the same time. What is the business model? Meaning, how do you go about trying to put together that data, making it interesting and useful, and then trying to get people to actually invest based on that?
Yeah, so I'll speak to the data first and then zoom out a little bit. We think broadly around what value can we bring to the market, right? We're not here to extract free rents. We want to make sure that we're bringing real value. And we center that around 3 themes internally. That's technology, data, and expertise, all of which matter tremendously. So I'll give you the data example here. If you want to go buy a house, in Phoenix, Arizona, 3 and 2, you got a pretty good sense what the thing's worth, like plus or minus 5%. The MLS exists, right? So that's the infrastructure for all of the information around what every house trades for on a per square foot basis. The same is true in the world of commercial real estate. There's a $30-40 billion public company, CoStar Group, that provides information on most commercial buildings, who occupies them, what the lease rates are, what the comp sales are, et cetera. Come over to our world, and it is shockingly absent in any of that type of common data substrate among the industry. So we found this to be a pretty big frustration. Like I'm sitting here looking at a stack of flyers that's 2 feet tall, which is how a lot of farmland is bought and sold. As bizarre as that sounds, we get them every day in the mail. So when we got into this, we immediately recognized that if we want to scale our business, we've got to be able to source well. We can speak about that later. But 2 is we've got to understand at a macro and micro level what's going on with each of these parcels we look at. So we've got a team today of 15 or so data scientists and engineers exclusively focused on our tool, Acres, lives at acres.com. And that is a tool that we've built to gather all that information from courthouses, from satellite information, from third-party data contributors and shares. And then from our team, we've got several other data analysts who literally go around every day, like watching auctions on YouTube and grabbing sale results from county courthouses and CDs they mail us, et cetera. So it's highly manual in order to compile this larger data set that allows us to be very nimble and very quick and look at something like 1,000 farms every quarter.
That sounds like a brutally manual process. If you talk about flyers, right? I mean, that I can't imagine sort of how maddening that can be. You must have certain minimum standards, right, to even consider putting something on the platform.
Without a question. And maddening is certainly one word, frustrating, right? But the other side of that is opportunity, right? In antiquated markets or places where things are not well understood, the old adage is in the land of the blind, the man with one eye is king. And so we have made very material and purposeful investments in what can be frustrating and manual processes in order to centralize and gather information. We actually then share a lot of that back with the farming community and landowning community in the US. We got like over 100,000 folks as an example that use that acreage tool we launched less than a year ago. And the rationale there is simple. We want to improve transparency. We want to improve liquidity here within this asset class so that we can continue to match farmers looking to grow their business with investors looking to invest in land.
Okay. Now, I think a lot of people are probably more used to investing, through mutual funds, through ETFs, because, they're highly liquid mark-to-market vehicles. I'm going to assume that the mark-to-market aspect of farmland is not exactly very easy, all right, to get a sort of real sense of what the value of a farm is, unless there's a comp or transaction. So how are the valuations determined, right, for a particular farm property that it's on the platform that somebody wants to invest in, but it's hard to really know exactly sort of what it should be sold at?
So that's a lot of matching those three core competencies I mentioned earlier, which is having the technology to underwrite and source and manage at scale, having the data to inform those decisions, and then still having a team on the ground that, got mud on their boots and they understand local market dynamics well. So mark-to-market's a fuzzy game in any world of private assets, and that is especially true in our world. And so it's one where we're very cautious around. And instead, in real estate, you often make your money on the buy and buying, right? And so we put an inordinate amount of effort in the early phases of diligence and underwriting to make sure that we're getting the best understanding of the drivers of value for a particular piece of land. And that's not just what is being bought at, but that transpires through to what improvements can we make. We usually make CapEx improvements on the farms that go through our platform. So what improvements can we make to that? What kind of return do we receive on those improvements? How does that increase the overall value of the land and the outcome for the farmer there as well?
So how does it work? Is it kind of a pooled type of investment, like a fund, or somebody puts more money to work, uses AcreTrader? What are they actually doing? I'm assuming they can see the farm and property right by location, but is there sort of a pooled way of getting access to the asset class, or is it still individual farm picking, kind of the equivalent of stock picking?
It is primarily individual farms. So we put up a farm, sometimes 2 farms a week onto our platform. And so the investor can come through and very quickly and easily create an account, create a digital wallet on our site, and invest in special purpose vehicles. So for simplicity's sake, each of those LLCs will outright own the title of that farmland. The investors are coming in and investing in a part of that LLC with standard governance wraps around it. We've got an investor relations team here that can walk folks through it and help them understand the varieties of the asset class across row crops and permanent crops and timberland, to help them understand a little more around the drivers of returns, the risks, the idiosyncrasies, and all of the details within each individual asset. So today, for investors, it is primarily a way to get exposure by building their own portfolio. We are also looking at launching some pooled vehicles or fund products. Those would be primarily in the wealth advisor space. So working with wealth advisors that want to get their clients access to farmland, but perhaps don't want to spend the time to go through and build portfolios one by one.
Is it fair to say that the bulk, if not all of those that are using AcreTrader are US-based investors, or how does the international side work, if at all?
That's correct. US-based investors.
Yeah, no, I assume that it's like I would even think there's also a national security issue aspect. If, for example, you ended up having China just trying to own up all these properties. Yeah, Bill Gates is not as scary as she, right? I think in terms of ownership. So it makes for an interesting kind of talking point. Okay, so let's talk about just broader growth in the space in terms of investor interest. I mean, obviously, AcreTrader is trying to build as a firm. Investing in farmland is slow, steady, consistent. Is the growth of AcreTrader along a similar trajectory, or have you seen kind of an exponential increase in interest?
We've seen a little more of the latter. We've seen some very material business growth ourselves. We've attracted some real venture capital dollars to help fuel a little bit of that growth and fuel some of these more intense investments in data and technology around our business. So we've seen certainly like very rapid growth in investor interest in the asset class. And frankly, we're really excited about that. We're excited to have more folks in the U.S. interested in U.S. farmland and bringing more investment dollars into rural America and helping farmers. That's a fun part of our business as well. So we work alongside farmers as partners to them.
So maybe that's a good transition to talk about farming itself and food security and kind of longer term trends around population growth. I've done a lot of work with the folks at 2Grim, right? That has these ag-based ETFs, and obviously they're talking up their own book, just like you are, in terms of kind of these longer term trends as far as ag goes. But take us through some of the shifts that are happening on the kind of food security fronts and how that interplays with the investing case in farmland.
Yeah, I may have to double tap on that the question there. As a general sense, like, to talk up the book, it's pretty simple to say we all got to eat. And so there's pretty consistent demand for the products coming off of farms and demand that's growing, right? I think the population is going to grow by several more billion over the next couple of decades. And so that's the most interesting macro trend, certainly. And then improvements on farm and productivity on farm help as well at a farm and parcel level basis. But I may have to ask for a clarification on the food security side as well, if that didn't answer it.
No. Just so obviously with Russia, Ukraine, right? I mean, there's been a lot of folks around exporting of wheat and how international dynamics factor into food supply. So has there been sort of a shift more towards domestic food production longer term because of what's going on the geopolitical front? And how does that play into farmland prices? What I'm trying to get at is there some sort of like structural shift in the way that people are viewing domestic farmland versus international food going from international farmland?
Gotcha. So look, I think that one, there are real deglobalization trends to take into account. And then two, there are like specific geopolitical events like the Ukraine war that are having pretty material impacts on commodity prices worldwide. Getting down to a more granular level, we compete very effectively on the world stage, given just the physical amount of farmland that we have, and then also the cost of transportation, given our extensive rail system and water systems throughout the United States. So we are very favorably positioned, and we certainly produce, as a general statement, are able to produce more than we need, and thus sell a good amount of our products into export markets. It's also interestingly one of those global trades that's less, what's what I'm trying to say here? It's needed, right? So countries can bicker and fight all they want, but the reality is that global food trade is pretty important to everyone to maintain.
How does efficiency of farming and technology impact farmland investing, right? So I think most people would say, the more food that has to be grown, put out there, the more property you need. It kind of goes back to the Malthusian way of thinking about things, right? Technology ends up making yield per acre more effective. How does that impact demand for farmland as technology for food improves and makes yield higher?
And as a general statement, yield improvements are not globally not fast enough to keep up with demand on a individual part. And frankly, a lot of those cost real money and take real upfront investments. So the example would be a grain farm in Iowa with bad drainage. The way you can improve yield is by going out and doing what's called a drainage tile project. And it basically putting think about complicated sewer systems underneath that to get the water off of the farm. And so those are very yield enhancing, but they require pretty material CapEx upfront to do. And a lot of folks working that land may not have that capital budget. So there, on an individual parcel level basis, there are real opportunities to improve yield and ultimately improve the outcomes for investors as well.
Right. That goes back to the expertise side on your end, right? Because you've got all of the data behind it and have the knowledge on how to do the improvement side of things. Are there some parts from a geographic perspective that you tend to see more interest in? I mean, obviously, again, it's based on, longitude, latitude, and, weather, right, for a particular farm. But presumably there's, speculative geographic regions and more conservative ones within the asset class.
There absolutely are, and well said, right? We have to take into account on a pretty massive underwriting checklist the immediate sort of global level factors, right? Our region and the climate within that region, the water availability, or as I mentioned a moment ago, in the case that often Midwest farms, ability to get water off of the farm. So climate, water, soils, so the productivity of those underlying soils and the versatility of them to grow a variety of crops. And then there's financial profile and tenant as well. Those things, zooming back out to sort of, at a regional level, there are certainly some areas that we absolutely don't go, and inversely some areas that we're excited about. I'll give you a sort of micro example of this, which is California, which has become a bad word in a lot of folks' mind. And when you think about farmland in California, there's immediate concerns around natural disasters and or lack of water availability. But the reality is, geographically, California is massive, like a truly massive state with some pretty great growing conditions and some areas with really great water availability. So I'll use the example of almonds. Something like 80% of global almond supplies come from one state, California. And within that state, there are a number of areas where they're growing almonds on top of water that may not be there in a decade, or certainly won't be there at that price. And so there's real likelihood that we're going to see large swaths of almond ranches come out of production over the next 5, 10, 20 years as that farmer is faced with the opportunity to replant almonds at their 25th year or whenever that may be. They may decide not to replant just given the rising cost of water. So that causes some real problems for that farmer and certainly for any investors that may be exposed in those areas or may be speculative enough to go play in those areas. Inversely, if you own almonds on top of really good water, you may be sitting in a great position, at some point in the future. If supply is coming offline and the implication is prices are rising and you're sitting on top of good water, that's a real opportunity.
What about volatility in weather patterns? I mean, let me talk through some of the exogenous risks, at least in a short term, for different farm properties. I have to assume it's going to be largely weather related, but what other things tend to cause variability in prices?
Weather is a big one. Natural disasters can be real. So like a hailstorm, here in Arkansas or Mississippi or in the Midwest can cause real damage as well. Most often we think about farmland and investing as splitting OpCo and PropCo, right? So you've got your operating company, that's the farmer, and the property company that owns the underlying farmland. You see that model quite a bit. Think about like hotel chains or casinos where there's a property company wanting the underlying more stable property exposure. And then there's an operator. They want capital efficiency. They don't necessarily want to own so much land. They want to be able to invest their incremental profits in growth of their enterprise. And so quite often there's real separation between the landowner and year to year variability in income on that farm. So that's and actually to drill in a little bit further on that, let's take the example of that hailstorm in the Midwest. There are various types of insurance, often government subsidized, that will kick in to help the farmer to make sure that, look, as a nation, farmers being solvent is pretty important to us and for food security reasons. So we, I think appropriately, back our U.S. farmers in times of bizarre or sort of, that 1 or 2 sigma event in the weather that may cause a really bad year.
Yeah, the insurance side, it's interesting, right? There's almost you could argue it's almost an unfair but justified advantage, right? That farmers have relative to other industries because, you got the government support there.
Well said.
Just to reset the room for the remaining 15 minutes. So everybody, please make sure you follow the AcreTrader Twitter handle. If you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcast under Lead Lag Live. Please make sure you check that out as well. But let's go for a question. Good.
Fun question, David. And while I'm no agronomist, the short answer is yes. The bee issue is very real and pollination is very real. In the case of California almonds, as an example, they're a high value enough crop where often you will see the farmer renting bee boxes. And so there's this whole industry. It's really fascinating of folks that will come out and set bee boxes on your property during the appropriate periods in the pollination or the growth cycle of almonds annually to help ensure that you do have a healthy bee population on that farm during that period. So it is a fascinating study or sort of subculture in the world of farming is that of bee farmers. And I think, frankly, some of them are doing really well financially based on what I've seen. They get paid to bring bees on site. Oh, fascinating. Yeah. I don't know the specifics inside their business. I know it's something like tens of billions of bees they bring out each season. And if they're, think about them as being farmers that are growing their own crop that is tiny insects, right? That's certainly concerning to hear. Inversely, maybe that helps them on pricing and helps them to drive more production and growing of bees. But it's certainly a fun little microcosm. And those types of both positive and negative scenarios are all across the world of farmland and really fun to dig into. Thanks again for the question. That's fascinating.
Let's talk about liquidity here for a bit. So somebody buys a farm or gets access to it. I'm going to assume that there's a lockup period, right? But maybe not. Presumably you want the real long-term investors. Again, no FOMO, but FOMO is real. What happens if somebody buys, something farmland from through AcreTrader and then, needs that liquidity for whatever number of reasons in a couple of months? Is there an easy way for somebody to then sell right away, or is there some lockup period?
Not particularly. So one, there is a 1-year minimum regulatory lockup period, given this type of private security. Then after that 1-year lockup period, and our farm durations are anywhere from 3 to 5 years, 5 to 10 years. So we like for people to think about this as being certainly a longer duration product. After that 1-year lockup, investors are free to sell themselves, and we can help the transfer of those shares should they have somebody else to replace their ownership. We've also worked on a secondary market technology, and from a regulatory standpoint for years. We have made great headway on the technology, not as much on the regulatory standpoint. So we're continuing. Our internal legal team is working with external legal team to continue to evaluate and understand what that would look like to get live, whether that's our own secondary trading venue or a third party.
From an asset allocation perspective, how do you typically see percentages of a portfolio? Meaning, is it, first of all, I'm going to assume it's bucketed in sort of the real estate REIT side of things for institutional investors, but what type of a weightings do you typically see people allocate to farmland?
We see people all over the board. They may have tens of thousands or tens of millions of dollars invested. We aren't exactly sure what the percentage is of their entire portfolio, other than anecdotally folks we speak to. And then, while we are certainly reticent to provide investment advice, or reluctant, right? We don't do that investment advice or allocation advice as a company. There are some third-party white papers out there that speak. I want to say like Nuveen has one out, saying like 3 to 5% allocation can help improve risk-adjusted returns. There are others that are higher than that. And then there's, So I guess runs the gamut in quite a wide variety. Obviously, this isn't hey, come replace your whole portfolio with farmland, but rather farmland can be interesting as a diversifier and improver of overall risk-adjusted returns.
Right. And it's important to know that, diversification often fails when you need it the most, right? And what I'm hitting on there is, during periods of higher volatility and recessionary periods. So talk through some of the historical behavior of farmland, again, in the context of that consistency point, when you have economic contractions and recessions.
So the last 2 or 3, that being COVID, GFC before that, .com before that. So call them, major adjustments, both in terms of public markets and also the broader US economy. We saw pretty consistent performance through those. So off the top of my head, the Great Financial Crisis, as an example, was kind of low to mid-teens in terms of farmland performance through 0809. So fairly consistent. Again, like it's not countercyclical. You're not going to get, history shows us that there's not like some intense countercyclicality to it where you get a huge rip to the upside when everything else goes down, but rather inversely just has shown some compounding through those more challenging economic periods.
Right. And that makes sense. And then of course, the other thing that I think people would come to mind with on this is how do interest rates impact farmland? So, obviously when it comes to housing, right? Higher rates, higher mortgage rates, problems there on the buying. I understand it's not necessarily levered in the same way, but how does the cost of capital impact broader demand and valuations?
I think the reality is higher cost of capital probably removes some of your incremental buyers from the market, or certainly some of the ones going after bigger prices. But you've also nailed on the head, or called out an important part there, which is system-wide leverage. Most farms are outright owned by their owners. Most farms on our platform, we are purchased without the use of leverage. Across the farm economy, or across the farmland economy in the US, it's something like 13 or 14% debt to assets. So compare that to CRE, where you have some funds running at 80% plus LTVs or mezz debt on top of that. We are running as an industry on a relative basis, very low leverage. And so that creates, and it tends to be a lot of that's like GS, we have a quasi GSE and Farmer Mac, so, and or the farm credit system. So a lot of those tend to be also longer duration fixed rate types of loans. So, not to say interest rates we are immune from interest rates. We don't know broader impact on buying behavior, though we can look across the system and say, all right, well, relative to things like, homes or home mortgages or commercial real estate debt, we have far less leverage.
Yeah, no, that makes a lot of sense. In terms of kind of the future of the company and, what you're hoping to accomplish, I'm going to assume that like everything else, you want to keep on advancing on the technology side. I'm reticent to throw out the AI term on that, but it's like all the rage But I'm going to assume that there is maybe some element of that in the input and then the output. What kind of advancements are happening on the technology side to get you to really get even more refined on the data that's being presented?
I think on the analytics side, there may be opportunities within the world of AI. I mean, I use ChatGPT every day, the 4.0 model, and think it's some really fascinating stuff. In our world, do I believe that computers are going to buy and sell farms? No. I mean, doing an appraisal is hard enough. An AVM, an automated valuation model, is effectively impossible. Where we focus our efforts really is instead being a data originator, finding unique sources and volumes of information out there that can help better inform decision makings and analytics built on top of that. So those types of models are interesting and exciting, but frankly, an Excel model sucks if you have garbage going into it. And right now, our industry is full of quite a bit of garbage in terms of data. So really big opportunity to us is much more on gathering and understanding data, being a data originator, and then the layers on top of that. In terms of where the company is going, broader scopes, I've tapped on this a little bit earlier, but an important part of our sourcing strategy is we source alongside the farmer. So we're looking for off-market properties where that farmer has relationships locally. They bring them to us because we are an equity finance partner. So it's a really important differentiator in our sourcing strategy and how we approach the market. From our big picture business goals, it's pretty straightforward, right? If we continue to create wins of outcomes for the farmers we work with and the investors we work with, then we believe we're going to build a really big business here.
Yeah, it's unique, and I'm sure it's not a very crowded space because of the fragmented nature of it from a competitive perspective. So you're certainly seeing any kind of a unique part of this world. For those that are thinking about investing in farmland, but just want to get a better understanding from an educational perspective, aside from going to the website, obviously, what are some of the sources that you would point people to just better educate themselves on the asset class?
There are a number of third-party public, and I appreciate you saying that. Look, we want you to learn everything you can at AcreTrader.com, and we've got reams and reams of educational materials there, but trust but verify, right? So there's a good amount of third-party research out there. In particular, Nuveen puts out some really great research through their Farmlands subsidiary Westchester. Prudential has some pretty great research out there as well. So, there are some good, and we've got links to a lot of that on our website as well. So we like sending people out to see third-party data. And then NCREIF, NCREIF, is our index as an industry, I guess is the best way to put it. So they track private equity real estate, farmland real estate, and timberland. And so from a pure data standpoint, beyond what we offer at AcreTrader and at acres.com, would point to NCREIF as a great source of information.
I think that's a good place to wrap this Twitter space up. But everybody, please make sure you follow Carter Malloy. Check out AcreTrader. Special thanks to David for making me hungry because I'm going to have some almonds now based on that question. I appreciate everybody that's again here. And thank you, Carter. Really appreciate it.
Thank you, Michael, so much. And thanks to all of you that dialed in today.